What's up everybody, welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's #2 economy. My name is Tony, let's jump in. Okay, happy Thursday everybody. First up, let's talk about some key economic and financial developments in the world's #2 economy. Capital outflows remain an area of concern for regulators. According to the latest report from Emerging Portfolio Fund Research, in the third week of March, global investors pulled out more than $3 billion worth of value from Chinese equities, the highest level in over a year. The report also found that China bond funds saw a weekly outflow of more than $1 billion for the first time. Interestingly, the report attributes the particularly high levels of capital outflow to, quote, China's refusal to condemn Russia's invasion of Ukraine, end quote, which, it could be argued, has investors concerned that China could be a target for sanctions from developed economies. Indeed, analysts have pointed out that while many Chinese assets are quite cheap currently, for many investors the downsides of China exposure outweigh the potential upside. The Financial Times writes yesterday, for example, quote, the trauma of investing in Russia, where sanctions and capital controls made internationally held assets effectively worthless, has prompted investors to look at China in a different light. End quote. State media in the mainland began responding to these concerns this week, seeking to reassure markets and arguing that this is all temporary. Quote, heightened geopolitical tensions, including the Ukraine crisis, may have also unnerved overseas investors, observers said. They said the recent wave of capital outflows reflected foreign investors' temporary disorientation. End quote. Shanghai-based electric vehicle manufacturer NIO Inc., which started trading in Hong Kong earlier this month, recently posted fourth quarter earnings that missed analyst expectations, being hit with the same issues experienced by others in the industry. Quote, the Shanghai-based company reported a net loss of 2.14 billion yuan, or RMB, $336.4 million in the 3 months ended December 31st. Revenue increased 49% from a year earlier to 9.9 billion RMB. Like its rivals, NIO has faced intense supply disruption across a number of items, from semiconductors to raw battery materials. The price of lithium has soared nearly 500% in the past year. End quote. And last up of the economic developments, we are getting yet more signals from high-level officials this week that greater support for the Chinese economy is on the way, suggesting that Beijing is becoming increasingly nervous about what they have been seeing over the last few weeks. With a property crisis and now intensifying lockdowns across the country, they really should be. In a statement yesterday, the People's Bank of China, China's central bank, reaffirmed it will step up the magnitude of monetary policy and make it, quote, more forward-looking, targeted and autonomous, end quote. State media also reports that the State Council, China's cabinet, has announced new policies to, quote, stabilize the economy as fast as possible, end quote. The State Council will introduce policies to quote-unquote stabilize market expectations, which includes the issuance of more special government bonds, typically used to fund infrastructure. This should be a few $100 billion worth. The issuance of these special government bonds will be, quote, first given to regions with strong debt repayment ability and a large number of projects, end quote. However, the list of viable high-quality infrastructure projects has been quite short for years now. Typically, local governments are forced to pour capital into projects with limited productivity gains and a dubious business case, as most good projects were built well over a decade ago. Next up, China's Ukraine war dilemma. This week, China's Foreign Minister Wang Yi met with his Russian counterpart Lavrov to discuss the Ukraine war. As we have observed before, the Ukraine war has put Beijing in a difficult position as the invasion undermines a key principle of international law that China has for years championed for its own interests, that of non-interference in the domestic affairs of other countries and the importance of sovereignty. China also does not want to damage its fair-weather friendship with Moscow at a time when Beijing is facing a very cold and adversarial international environment. But at the same time, it doesn't want to alienate Europeans either and push them even closer to a US-led anti-China coalition. The diplomatic readouts from the Wang-Lavrov meeting are fairly boilerplate, and about what we would expect, expressing, quote, "Noting that the Ukraine issue has a complicated history, China supports Russia and Ukraine in overcoming difficulties to continue their peace talks." End quote. Beijing's public statements still remain firmly behind Moscow, with the foreign ministry expressing after the meeting too, quote, "There is no ceiling for China-Russia cooperation, no ceiling for us to strive for peace, no ceiling for us to safeguard security, and no ceiling for us to oppose hegemony." End quote. As we should know by now, when Beijing speaks of opposing hegemony, they are talking about opposing the US and at times the West generally. After a series of articles in the People's Liberation Army state-run media last week, highly critical of the US and blaming the US for the Ukraine crisis, this week China is rolling out a new series of articles, but these articles are printed in the highly authoritative central state-run People's Daily. This suggests that state ideology and state media officials are happy with this particular narrative and they want to run with it. State media has shown that it is fine with bitterly criticizing the United States. However, attacks on NATO also risk alienating actors in the EU, something I would argue Beijing still wants to avoid. On this point, Washington-based veteran China analyst Bill Bishop expressed yesterday, quote, "I am not sure PRC policymakers understand that the increasingly shrill attacks on NATO will help its relationship with the EU, or perhaps they have a Marxist view of things, and so believe that the EU, and especially Germany, are too economically reliant on the PRC to actually do anything that would significantly damage the EU-China relationship." State media is producing daily articles for a domestic audience as well, seeking to paint an image of a responsible and peaceful China, contrasted with a warmongering and hegemonic US. This is what the state-run Xinhua published yesterday, for example. Quote, "While China pursues mutual respect and peaceful coexistence, a major Western power has refused to abandon outdated Cold War mentality and sought absolute security for itself at the costs of others, leading to disputes, tensions, and wars in many parts of the world. Over the years, while this Western power exports war, destruction, and hatred in the name of democracy and human rights, China has brought investments, jobs, and key infrastructure to many countries." End quote. We should expect China to employ these narratives for an international audience, also going forward, as Beijing scales up its international information dissemination campaigns. Finally, while we're on this topic, and this is very interesting I think, I've been seeing a national campaign to get teachers across the country behind Beijing's official line on the Ukraine war and, quote, "guide students' understanding of the conflict," end quote. Hong Kong-based South China Morning Post spoke to experts in the mainland about these efforts. Quote, "Beijing-based independent political analyst Wu Qiang said that the campaign was intended to unify thoughts and defend China's policy over the war in Ukraine, which remained a pressing agenda for the central propaganda and education departments." He also pointed to an emerging anti-war sentiment within China, especially among social and party elites, which the campaign was intended to counter. End quote. And last up, the housing crisis. If you guys are enjoying the content or get some value from the content, as always, it's a huge help if you hit that like button. Thank you very much for all the amazing support, everybody. If you're watching for the first time, and like I said, you get some value from the episode, you think this is useful, or you enjoy the content, I release one of these every day, so if you want to be on top of the most up-to-date analysis on China, hit that subscribe button and the bell notification, and you'll have these when they're published. On Monday, major private developer Sunac China Holdings Limited, a player that we've been following for some time now, became yet another Chinese housing developer, admitting that it is in hot water. It has joined almost half a dozen other major developers in announcing that it would be unable to publish its unaudited 2021 financial results as scheduled on Thursday. Today. It also admitted that it is having difficulties getting creditors to agree to its proposed extension on an onshore bond. Soon after this, developer Yango YANGO Group Co. Limited announced it would default on a 538 million RMB, $84.4 million onshore bond and 3 offshore bonds. Sunac is China's third largest developer by sales. The day after these announcements, Tuesday, its stock traded in Hong Kong dropped 17%. Then on Wednesday, yesterday, Sunac China Holdings Limited offered better terms to investors with a new payment extension for a 4 billion RMB, $629.2 million onshore bond due the 1st of April. Tomorrow. Markets seem to have liked the move with an 18% rally in share prices that day, Wednesday. Meanwhile, in a development that markets certainly aren't happy with, it looks like global accounting firms are jumping ship. Japanese-owned UK-based Financial Times writes this week that the Big Four accounting firm PricewaterhouseCoopers, PwC, which audits more than a dozen listed Chinese developers, is under investigation in Hong Kong over its Evergrande audit. It and Deloitte have resigned as auditors of at least 5 Chinese developers in the past 3 months. The Big Four, Deloitte, PricewaterhouseCoopers, KPMG, and Ernst Young have spent years building operations in China, auditing about 140 of the approximately 270 US-listed Chinese companies, according to the Financial Times, with 1/5 of their global revenues coming from the Asia-Pacific region. As such, the recent resignations from established and powerful accounting firms just goes to show how sick the industry is and how concerned these firms are by it. There may also be attempts to avoid liability. Quote, one bondholder in a major Chinese property developer said that his investment company was exploring whether it could bring professional negligence claims against the developer's auditors. End quote. And then there is this disquieting and frankly quite vexing observation, quote, auditors are now taking their jobs a lot more seriously than they may have in the past. The quality of disclosures has been historically very poor. End quote. With the country now facing a multi-trillion-dollar crisis, I think we can all agree that the quality of previous disclosures has been very poor indeed. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.